right, as always, we like to start off with the asset class returns. Unfortunately, this chart here for April does not look very good at all. What you're seeing here is basically across the board, the market had a pretty lousy month. Large caps down almost 9%, small caps almost 8%, real estate down 3.5%. So it did perform relatively better, so that's good. Developed and emerging market stocks also down considerably, although not down quite as much, so that is a promising sign, but again, pretty bad year to date. Fixed income continues to struggle. Interest rates have continued to tick up. The more we see these inflation figures, the more the Fed has to be included in the conversation in their raising of rates. That's also been starting to hurt high yield a little bit more too, because just the talk of raising rates, it starts to get people to think about, well, what if they do too much and there's a recession? So we'll talk more about that here in a little bit. But thankfully, we've had commodities really save the portfolio so far, up 30% year to date and another 3.25% for the month. And again, we do have a healthy exposure to that. And as you'll see in the end, we're going to be adding a little bit more to that as well, as I see inflation looking like it will continue to persist. All right, and now for the market update, we're going to basically talk about three main topics, the ones that have been on pretty much everybody's mind probably. Number one being inflation, the Russia-Ukraine conflict, and the lockdowns in China. So let's go ahead and get started with inflation. Now, as you see here from this graphic, inflation has continued to go up. We are now at 8.5% for our last reading back in March. We're getting ready to have another one for the month of April come out next week. It came out pretty high, 8.5%. And I wanted to explain a couple things that are going on kind of underneath the water. So there's demand side and there's a supply side to prices, right? Because inflation is when prices are going up. And so on the demand side, you see that's where you have all this, first of all this pent-up demand from people finally getting out, right? And they're finally getting out and spending on trips and getting out to theaters and whatnot. And so that demand is out there. We have very generous fiscal stimulus and unemployment benefits that are being used as well. And I'll talk about this more in the outlook. But the consumer is very healthy, so they're out there spending. So we've seen the Fed in the news quite a bit lately, and they just raised rates 0.5%, the biggest move they've done in a while, because what they're trying to do is they're trying to slow the demand. And again, that's all they can do. They can't control the supply, which we'll talk about here in a second. They can only try to control the demand and try to slow it down, because when interest rates go up, you see it's kind of like gravity. It makes everything slow down. Now the problem is it's a very delicate balancing act, like I sent out in my letter a few weeks back. They got to go right down the middle and be really careful, because if they slow demand down too much, it can create a recession. That's not good either. So this is a very tricky situation the Fed is in. The supply side, they cannot control at all. And we know what happened. It was COVID, the bottlenecks, labor shortages because people were afraid to get out and work. There are all kinds of issues that happened initially with the supply side. But now we're seeing two new things that have been introduced, which are also creating even more problems for inflation. And those we're going to talk about next, which is Russia and China. Okay, and now we have the Russia and Ukraine problem that's adding to the inflation problem as well. This is really more of a supply side problem. Again, the Fed really can't do anything to control what Putin's doing over in Russia and Ukraine, right? So we talked about this before. Russia, Ukraine, they have a big influence on what's going on with the energy prices, because they have so much energy that flows out of those countries, and also the food prices. I don't need to tell you, you go to the grocery store now, food of all kinds go up. That part of it is because of energy prices, but also because of all the different commodities that are involved in food. And a lot of those commodities come from Ukraine and Russia, and the war and the sanctions is just clogging everything up. And so unfortunately, this war does not look like it's going to end anytime soon. The more and more I read about Putin, this would be an existential threat to Putin if he were to just walk away losing. Okay? He is not going to walk away losing. He's going to get something out of this. And when you have nukes, you can pretty much push your weight around and get something. And so my fear is that this could persist for maybe a whole year, going to next year possibly. If it doesn't, that would be very good for the energy and food prices, but if it continues on, it's just going to keep those prices elevated for longer, unfortunately. And then we have China, another kink in the supply side problem. Just when we thought it couldn't get worse, right? So China, they've had this resurgence of COVID, okay? Remember the country that said that they handled COVID better than everybody else? Well, because of that and all the draconian lockdowns that they did a few years ago, they never really took care of COVID. They don't have a lot of herd immunity. And their vaccines really haven't been that effective. And so they're getting these resurgences come back, and they're locking down cities just like they did in 2020. Because again, they don't want to admit that they were wrong and locking everything down. So they're going to just continue to lock things down. And my concern is that President Xi and the whole government there is they're so committed to the strategy, and it would look weak for them to back out of this strategy, that they're going to continue this lockdown strategy. And so when the COVID cases go down, they'll open back up again. And when they open back up again, what will happen? The COVID cases will go back up again, and they'll have to shut things down. So my concern here is that they may have to continue to open up and shut down here for probably a long time, maybe through the whole year of 2022, hopefully not too much longer. But again, you can see where I'm going with this. This is going to slow down global demand, which a little bit of the demand side, but more on the supply side. China makes a lot of stuff. A lot of stuff comes out of China. And so as that continues to get bogged down, the supply side issues that we talked about with inflation are going to continue, unfortunately, to persist for a little bit longer. Okay, now in the market outlook, let's talk about what we see going forward. So the first thing to really talk about is the big picture, and that is, are we going to go into a recession? Is the Fed going to slow things down too much to create a recession? Okay, I think that we are in a very precarious spot, like the graphic here with the dominoes. I think we're probably in a position where it's about a 50-50 chance. I know sometimes that's a little bit of a cop-out, but it could go either way. If some of the supply side kinks get resolved sooner than later, then things can start to recuperate, I think, very nicely, and then the Fed will start to back away and slow things down with the rate hikes. If they persist or get worse or something new comes up, that's only going to make things worse. And so that's why I am kind of on the border between we're going to go into a mild recession, or we'll just have a slowdown and then we'll be okay. So in the next couple slides, I want to show you essentially why I am not super pessimistic. It seems like it's actually pretty popular right now to be pessimistic. You look smarter. But frankly, there are still some very positive things out there which keep me from going all the way down this pessimistic trail. Now, one of the things is the consumer debt is down dramatically from where it was many years in the past. As you can see here from this chart, we're down to about 9% of debt as a percentage of disposable income. This is one of the lowest debt to income ratios we've had in a very long time. So again, what does this mean? The consumer is very strong. Maybe they can withstand a lot of the Fed's slowing down of the economy. The other aspect I would like to add as well, as you can see here from this article on the American Association of Individual Investors, they do a survey every week, and it asks people, how bearish, how bullish, or neutral they are. And as you can see here, the survey that recently came out showed that they're reaching the highest pessimism level since they saw in March of 2009. You realize that was the worst part of the great financial crisis, and in fact that was the month when things turned around. So kind of interesting. And finally, I'd like to counter a point that I've heard many people say in the news and as I talk to people, that the stock market was really, really expensive, and with interest rates going up, it needs to correct quite a bit more because of how expensive it is. But I wanted to show you where interest rates are and where they've been. Okay, so this is the interest rates, and the PE ratios, where they are and where they've been. And as you can see here, the PE ratio right now for the S&P 500 is now somewhat reasonable. We've gotten back down to about 21. And as you can see here by the 5-year, this is the 5-year Treasury, we're right around 3% on the 5-year Treasury. And you can look back, last time we were at around 3% on the 5-year Treasury. There was a couple different times. You can go back, for example, to 2003. You look at 2003 on the PE, and we were much higher on the PE. Okay, so one could argue where we are right about now in interest rates is actually, there's been many instances where the stock market's been more expensive than where it is today. So actually making the reverse argument. And of course, to get the PEs lower than where they are today, you'd have to go back to maybe like in the 70s and 80s. But you can see in the 70s and 80s how high interest rates got. 10, 12, 15%. So there's not a lot of consensus that interest rates are going to 10, 12, 15%. A lot of economists are saying that we're probably going to get in the 3 to 3.25, maybe even 3.5 range on the 5-year. I'm more on the lower end of that. And so I think that where we are with the valuations does seem reasonable and not super expensive. And so to conclude, I showed you some of the issues that we're having with inflation and why it may persist for a little bit longer, even though there are going to be some signs of life. I do think the CPI is going to start to maybe flatten out here a little bit, but unfortunately what's going to happen is it's probably going to stay, it might go down a little bit, but it's going to probably still stay pretty high for a while due to those supply side issues. The Fed will not be able to control those issues. And the longer those supply side issues last, the longer inflation is going to persist, which means the more the Fed will feel like they have to do something. And that just raises the probability of recession, which is why I'm looking at about a 50% probability. So what am I doing? Right now, I am taking the portfolios down to about a neutral level with their benchmarks as far as the risk. We were leaning a little bit into a little bit up more on the stocks, but we're going to pare that back just a little bit, add a little bit to commodities, a little bit more to like a hedged equity type funds, and even a little bit into bonds just in case there is a recession, because bonds do tend to outperform in those periods. Again, very small because I'm still not in the camp that this recession is a done deal. I think we still have a good chance where we can avoid it. But let's not be too risky at this point. It's probably a time to be a little bit more cautious.